Hi everyone, welcome to this short video which will walk you through Activity 9.1, reviewing a set of financial statements. My name is Cormac and I'm one of your module leaders. So a key responsibility of auditors is to perform a detailed review of the client's financial statements. Now, as you know, a set of financial statements comprises much more than just a statement of financial position and a profit and loss account. It includes the statement of changes in equity, cash flow statements, and all of the relevant note disclosures. So at this stage of the audit process, you will have completed all the audit testing and you have a draft set of financials. In this activity, you're given a statement of profit or loss, a statement of financial position, and some notes. You are asked to identify any errors or inconsistencies and to explain the course of action the auditor should take for each one identified. We recommend you attempt the activity yourself before looking at this video, but if you've already tackled it, then let's get started. So let's quickly summarize who the main parties are and the key elements of the scenario. So Scholes Limited is a listed entity with a June year end. The audit report is due to be released on the 11th of August 2003. It's now currently the 1st of August. And you're told that all the audit work has actually been performed. And as we mentioned earlier, you've been given a statement of profit or loss, or a P&L as we call it, a statement of financial position, or a balance sheet as it's commonly known, and you've been given some note disclosures. So with the exam in mind, it's always worthwhile being crystal clear what the required is asking us to do. So you're being asked to do the following: review all the information provided and identify any errors or inconsistencies within the financial statements. Explain the course of action the audit team should take for each error or inconsistency identified. So there's a few important points here that are worth discussing. First of all, the two main task words are identify and explain. So this tells you that you not only do you have to identify any error, but you must explain what the auditor must do in response to this. There's also another indicator here as to what we were looking for. Remember, you're being asked to identify errors or inconsistencies. This means that there could be an adding error, for example, or perhaps there's an inconsistency between one of the primary financial statements and the respective note disclosure. So now you have an understanding of the scenario and the required, you can actually start your review. So as the steps prescribed in the suggested solution, the best place to start is by looking for errors in isolation of anything else, and then looking at the information collectively. The best way of doing this is performing steps 1 and 2 for the P&L, and then repeat steps 1 and 2 for the balance sheet. Step 3, consider courses of action, can then be covered at the end of each element. We can therefore make a start by following steps 1 and 2 for the statement of profit or loss. So without yet looking at the note disclosures, there does not seem to be any errors in the financial information presented on the face of the P&L. The numbers add up for both years, with no clerical errors noted. The next thing to do is to see if the information is consistent with other areas of the financial statements. So let's look at the notes that relate to the statement of profit or loss. The first note that relates to the P&L is Note 3, Revenue. So are the two consistent? So from comparing the two, you can see that other income was disclosed separately on the face of the P&L, but not in the note. The auditor will have to take action here. So it's important to note that the action the auditor should take is to request management to make this change. Remember that management have responsibility for the financial statements being correct, not the auditor. Your course of action should always be reflective of that. So let's look at another area of the P&L. Okay, so knowing there is a note on PP&E, Let's look for any inconsistencies in depreciation expense. When comparing the two, you can see that the expense in Note 12 does not agree to the expense on the face of the P&L. So even though this is only $1, this should not happen, and the auditor should again propose some action. In reality, a listed client won't have their financial statements presented to the dollar. They'll more than likely be rounded to the nearest thousand. So this is just to illustrate that this would still be in effect. Obviously, the client will want their financial statements to be accurate, so it would be in their interest for the auditor to tell them of any inconsistency or mistake that they find. So again, take note of the fact that the auditor is not making the change. Instead, they're comparing the number to the work performed in depreciation, and once they know what the number should be, they request management to make the necessary changes. Okay, so let's turn our attention to the balance sheet, or the statement of financial position. Remember, the first place to start is step 1, just looking at the balance sheet itself in isolation for any errors. So here you can see straight away that it doesn't actually balance, as the net assets do not agree with equity. In this instance, we can go straight to step 3 and propose a course of action. Similar to the P&L, the onus is on management to fix the mistake and record the correct numbers that were in the trial balance. You will see the wording of this in the suggested solution. So as we know, the next thing to do is then look at the balance sheet notes and check for any inconsistencies. Similar to what we did a couple of slides back, the same exercise can now be done for the balance sheet, where we try and identify inconsistencies between the notes and the primary statement itself. On screen here, you can see how some inconsistencies have arisen and the proposed course of action. For example, Note 8, cash and bank, is called cash and cash equivalents on the balance sheet. Similarly, in Note 9, trade receivables, per the balance sheet, this should also include prepayments, but the note does not include this. So whilst these might seem quite obvious, there are some instances where mistake or inconsistency is not so obvious. So let's take a look at what these might be. Whilst you may be focusing on the numbers in your review, don't lose sight of the fact that all information requires a review and has a potential for mistake or inconsistency. Let's look at a couple of examples. You were given some narrative around the director's report, but if you read carefully, you will see it looks like they've simply rolled forward this text from the prior year and not updated to 2003. The obvious action here is to request management change this from 02 to 03. Similarly, we're told that accounts receivable were not impaired, but we have a provision for impairment in the note, hence these are conflicting narratives. Also, we're told that landing buildings are not depreciated, but it has a depreciation expense in Note 12. In each instance, the auditor must again report these to management and ask for the necessary changes to be made, corroborating the correct information to the audit work already performed and evaluated. So that was a quick run through of the P&L balance sheet and notes. And obviously we encourage you to reattempt the activity yourself. But let's quickly just recap our approach and what we've done. So we performed steps 1 to 3 for the P&L first of all. We then repeated this for the balance sheet or statement of financial position. And then we did this for the note disclosures, also with a focus on the narrative and the text. So as you can see, there's quite a few different types of mistakes or inconsistencies. So what are the things that you're looking for? So things like the totals and subtotals not adding properly, the numbers on the primary statements not matching the notes, ensuring there's consistent description in note disclosures, that the note numbers themselves actually correspond to the notes, and that the terminology and dates are correct. And there may be other types of inconsistencies or errors that we haven't touched on here. So this list could also be added to. The last key point to reiterate here is ensuring that your course of action is relevant and appropriate. It's therefore important to remember that it's management's responsibility to amend the financial statements, not the auditor. If, for example, this was your course of action, this would be incorrect. The auditor should request management make the amendments and can use their audit work to corroborate what the correct number or narrative should be. If you were to give this type of action, this would be correct. So it's important to remember this golden rule in an exam scenario. So once again, thanks for everyone for taking the time to watch the video. We hope it was somewhat useful. Keep your questions coming into the discussion forum. And on behalf of myself and the other module leaders, good luck with the rest of your studies. Thank you.